Hey everyone, it's Dr. Mike, your real estate doctor from Exit Realty Northwest in Hoffman Estates. I am here with the great Glenn Moreno with First Centennial Mortgage, and we are going to give you another
Tip of the week.
Glenn, we've gotten great response to these buyer videos we've done. We talk about the buckets of cash, both from current buyers I have, people who've seen the postings online give me great feedback, great questions. My son's favorite show was MythBusters.
Oh, yeah.
And so I've gotten this idea now that these things we're talking about, I'm going to call them my buyer's MythBusters. And we've only covered 2 of the 4 topics. So I wanted to get into this third one. And bear with us, folks. This is kind of getting some of the nooks and crannies of the contract and the real estate process, but it's a difference between saving hundreds and thousands of dollars in the process if you need to. So we're just going to talk about that. I'll let Glenn take it over a little bit and give you some ideas about what's going on in this third bucket of cash.
Yeah, Mike, it's a real important bucket because it's the bucket that in essence gives them a credit.
Money back.
So many of our customers go to closing and they say, I know I have to come with an insurance policy and pay X amount of dollars, and I know I got to set up escrows. But what they don't realize is that in this third bucket, which we're going to call the prepaid interest and escrow bucket, it really ends up being a net credit to them,
They're going to get
which
money.
reduces the other 2 buckets that we talked about, the down payment and the closing costs. So
Exactly.
getting into it, prepaid interest, that's going to be the first part of this. It's defined as anybody who borrows money from a financial institution must pay from the date of the closing, well, you're starting to use their money,
Correct.
until the end of the month. So if we as professionals counsel our customers to set up their closings per the contract toward the end of a month, so if we're going to close at, say, the end of May, if we close on May 30th, they're going to use the money on May 30th, May 31st, 2 days worth of use of the money.
Right.
And if it was at $20 a day, they'd have to set up or come to closing with $40.
Gotcha.
Cool.
So a real estate professional like me writing the contract, or someone who I have is a little bit cash strapped, this could be the difference between having to come up with $40 or $20 a day times 30, like $600.
Oh,
Just changing the date by a couple of weeks for someone who's cash strapped could make a difference in closing costs.
Absolutely. If you had set it up for, let's say, May 1st, now you're talking about somebody that's going to use money for 30 days,
At
and now you're
$20
talking about hundreds of dollars instead of $40. So
Just changing the closing date would help.
great tip right there.
Right.
Absolutely. Next is going to be your escrows. In most real estate transactions, you have to set up 2 types of escrows. One's called hazard insurance, the other
Yep.
real estate taxes. Hazard insurance is pretty plain and simple. The lender is going to ask that the customer go out and shop with Allstate, State Farm, whoever they want to, and
Yeah.
come to the closing with a 12-month paid-up policy. Okay, great. So the first year's premium is all paid up. The lender, however, is going to ask them to set up a 2-month cushion. So there's going to be 2 months set up in the cushion, because then throughout the next 12 months, the lender will collect 1/12 of last year's premium. But in essence, you're going to have 14 months in the cushion. And why? Because we don't know whether or not the insurance company is going to raise that premium up. We don't want to be short when the bill comes out. And so it's just going to be a very easy way to pay the next year's bill.
Got it.
So again, if we assume that it's going to be $30 a month, $360 annual premium, that's $30 a month, times 2 months into the cushion, our customer is going to have to set aside $60.
Okay.
Okay? Now we're going to move on to real estate taxes.
Oh boy.
Yes, real estate taxes. You have to look at the month that you're closing in.
Correct.
And we're assuming that we're closing in Cook County, and the taxes are due twice a year.
Yes.
In March 1st and September 1st.
Right. Okay.
So what we're doing here is we're assuming that our client is closing at the end of May, and per the chart, we have to come up with 6 months worth of escrow at the closings.
Chunk of change.
And let's assume that it's a $3,600 tax bill, and so that's $300 a month. 6 months times $300 is going to be $1,800.
Yes.
And just to show people how it progresses, they set up 6. They don't pay any payment to the bank in June. Their first payment is July 1st, so they'll have 7 months in the escrow.
Yes.
The tax bill is due on September the 1st, but no lender waits all the way till September the 1st. They're going to pay it in late
End of
August.
August.
So in August, they've got 8 payments in the escrow, minus 6, meaning half a year's worth of taxes are paid.
Just to
And
do
so
that
now the
2-month
customer
cushion.
has a 2-month cushion still.
Yeah.
Then there's 3, 4, 5, 6 months by the end of December. Coming over to January, there's going to be 7 months by February. By the end of February, I mean just before the next bill, when it comes due March 1st, There'll be another 8 months in the escrow for the customer.
Right.
The lender will take out 6 and leave 2 in the escrow.
Excellent.
So again, depending upon the month you close in, you'll be setting up, in this case, on our example, 6 months or $1,800.
Right. If you're confused, take a snap of this whiteboard. This thing's great.
So it looks like in this bucket we've got about $1,900, and so people are going, oh gosh, this is getting to be a little expensive.
Yep.
But then all of a sudden we have to realize that the seller is going to give us a real estate tax credit because in the state of Illinois we pay taxes in arrears, which fancy term for in the year 2016 we're paying really 2015's real estate taxes. So how does
buyers like, I didn't live there in 2015?
Absolutely. And so what we've got now is, again, assuming our May 31st, 2016 closing. So for the first 5 months of 2016, our customer didn't live there.
Right.
So the seller has to give at least 5 months of credit for 2016. Well, again, that's 5 times $300. So there's another $1,500 in credit. But again, we have to look at, did they completely pay all the taxes in 2015 that were due in 2016? If we close on May 31st, the second installment that was due on August the 1st didn't get, I'm sorry, by September 1st, that has to be the responsibility of the
new occupant.
Well, they're going to actually physically pay it, but the seller has to give them a credit. So the seller is once again, for the second installment of 2015 taxes,
which is due this year,
and our occupant, our customer, is going to physically pay it, but the funds for the payment of that are going to come from the person that actually lived in the house in 2015,
correct,
which is our seller.
And so
we now have 6 months of 2015 taxes plus 5 months of 2016 taxes for a grand total of 11 months of real estate taxes that, in essence, cash credit will be coming from the seller, or $3,300 will be given to our customer as a credit.
Right.
So that $3,300 against this $1,900 worth of setup of escrows and prepaid interest nets them $1,900 in a credit.
Right.
Which will then reduce bucket number 2.
2 or 1 or whatever you need.
Correct. So it reduces the amount of cash that our customer has to bring to closing.
Awesome. And a little small thing, this is a part of the contract where they do tax prorations. And because there might be, you'll see in there's a senior exemption because the property taxes are low because a senior lived there. Or we just don't know what's going to happen in the next year in terms of your local assessment. There's a little number in there as a percentage. So we prorate this payment, not just at 100%, but we put in 105, sometimes 110. So the seller's giving you this money at 105 or 110 because we don't know what's going to happen this year. It could change.
Absolutely.
So your real estate professional needs to know what that line is about and explain it to you to say, this is why we're putting it at 105. Many real estate agents don't even understand this very well.
Right, because the tax bill for 2016 is not going to come out until 2017.
It's very Illinois, what are we going to do?
Therefore, since we don't know what that actually is going to be, most professionals like yourself put into the contract, well, I want 105%, I want a 5% bump up or a 10% bump up off of the current tax bill, because we don't know what the future brings.
It's going to make that number bigger.
Absolutely.
By that much, by that 5-10%.
So this is kind of a great bucket because it does come up with a credit for all of our customers. The only time it doesn't work is on new construction, but we won't go there right now. But because most people are buying existing units right now. So again, if you have any questions regarding this third bucket of cash, please get a hold of Dr. Mike or myself, and we'll be here next week with another Tip of the Week. Have a great day.